Okay, so the Fed is melting down the housing market. Now, I have flipped over 100 houses and I've sold over 200 houses. So I'm going to add my unique perspective into this and what you need to know for buying, selling, investing, or staying on the sidelines, because there's a lot of questions that pop up because of this and a lot of things that need to be answered. We have a crypto channel where I talk about crypto investments, but this is my real passion. So I'm excited to talk about real estate. So follow along for the journey, because I'll be posting videos at least every day, or excuse me, at least every other day about the real estate market, about the housing market, because honestly, it's just what I've been doing since I was a kid. So prospective home sellers and buyers retreat as mortgage rates approach 6%. Now, let's just quickly hit this macroeconomic information, because we have a lot to go through, including this graph, which is probably the most telling thing that we're going to see from the housing market over the next year. I think this graph really sums up pretty much the crisis that's going to go on, and that is going on right now. And I'll explain that in a second. That being said, on a macroeconomic level, can't even talk today, the CPI data came out, right? And that CPI data talks about inflation. Now, the inflation data was more than expected when it came out. It was supposed to come out at 8.1%. It came out at 8.3%, which means there's a lot more inflation in the economy than what the Federal Reserve Board was expecting. Now, why do we care? Because we care because the Federal Reserve Board has all these little levers and pulley systems in which they can tame inflation with. Now, we're just going to hit on this for one more minute, because then we'll get into everything else, but we kind of have to lay that foundation. So when it came in hotter than expected, they said, "Oh shit!" Basically, we're going to have to pull more money out of the economy. We're going to have to shrink this down from an 8.3 to an 8.2, 8.1, 8, 7.9. They want to get it around 2 to 3%. That is the magic number that people smarter than me came up with about inflation. So they want to get it at 2%, and it's at 8. So huge difference. And we could see that there's been a stock market meltdown over the last 5 days, just reacting off that data. So that 0.2% was big enough to scare the entire market down. Imagine how much worse is going to have to get in order to get those numbers down to the inflationary levels that the Federal Reserve Board wants. Now, so what do? They come out and say, in order to tame this number, we're going to have to move their causes a good versus bad investment with a single family cap rate in the US. Now, this gets so exciting and so interesting, because when you get your 6-month treasury yield curve up to the point where your cap rate is, then it starts to become not as good to buy single family residential real estate, because your returns are going to be just as much as your returns on a treasury bond. Now, let's explain that a little bit more, because a treasury bond, if I want a treasury bond and I'm a big institutional buyer, I got billions and billions and stacks on stacks, like a rap song, then I just go in there and I just, click bop, 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 buy with my little phone, and then I own my, let's just say 4% return treasury bond, and it is backed by the government, and you do it with a click of a button. So that's easy, right? Makes it very easy. Now, even if your single family real estate investing cap rate is within, 1 or 2 point, like 0.1 or 2 percentage points of that, it's still going to be more advantageous for you to buy a treasury bond, because instead, when you are investing in a real estate asset, you have to go find the asset, you have to negotiate, you have to buy it, you have to manage it, you have to deal with any kind of repairs that come from that property, you have to put a tenant in there, you have to deal with them, you have to have a much more active strategy in order to get this return in real estate. So you have to have more of a back operation, you have to have more staff, you have to have, it's just a harder investment. So if those rates of return on your real estate investing, single family, versus your rates of return on a treasury bond are anywhere close to freaking similar, which they're very close to similar right now, you're going to be putting all your money in treasury bonds. Now, why is this important for you? Why do we care? Who gives a shit, right? We care because the main people that have been buying up the massive amounts of inventory in the single family housing markets are hedge funds over the last 10 years. BlackRock, etc. American Homes for Rent at one point have purchased all these homes in their hedge funds, and they bought up a lot of the market, sometimes up to 30% of local markets at the same time. Now, the majority of the home buying market in real estate for single family are individual buyers, so let's not get that wrong. But hedge funds represent enough to make a huge splash and to really pivot the direction of which real estate is going. So now that this is switching, it's more advantageous for them to dump these investments and to buy treasury bonds, number one, and also number two, to not get into these investments at the first place. So not only are they going to be selling out of a lot of their inventory, which we can see right here, and we can see right here in this Fortune magazine article, the housing correction intensifies with Blackstone to stop by, it was Blackstone, BlackRock, they're spinoffs, to stop buying homes in the 38 regional housing markets. Of course, it's behind a freaking paywall, but basically, it's just proving the point that we just said, right? That these hedge funds are stopping the investments, and not only that, they are dumping their investments as well too, which leads to a couple different things. It leads to high rates of for the California real estate market. You can see right here, if we go to supply, and I think it's down here somewhere else, just looking at it. Okay, let's see, California housing supply, right? So we're up already 2.3% for a year-over-year return. And you can see the all types of homes right here. And if we just go right here to single family, we can see that in January 2022, it was at a year low. And we can see how the supply is creeping up. Now, this is just one market, of course, but it's at August, higher levels than it was from the year over year already, right? And this is just kind of starting. We can see the newly listed homes are, this is the number of home for sales, higher. Newly listed homes are down in this particular market as well. So sellers are not listing their homes right now, which that's pretty good for California supply, right? But what that is going to do is that is going to show a housing market that is drying up. So we can also see right here too, which is the kind of the most scary thing, I think, is the homes with price drops. 20% more homes are having price drops in this year. I mean, this has gone exponentially up. So what's the move here? What's the strategy? The experts say that as the Fed overshoots kind of their interest, so as they push up interest rates, as we can see right here, that within 12 months there's usually a recession, right? So I think for my bang for my buck, and you never really know what happens, right? You never can guess the future, but you can look at historical trends. You can look at some of these macroeconomic trends and some of these things that are happening and say, all right, well, there's a 80% chance that this, and this is going to happen. So there's also a 20% chance that it won't. So you're not all of the time going to be right, but if you can stack the chips in your favor, if you can stack the percentages in your favor as far as getting a good return on your investment, then that is, I think, what you should do, and that's how I like to look at it. So what you would do here, what I would do here, is wait. And I hate waiting because you should always be, in my opinion, you should always be buying assets, But you can jump asset classes based off of the frothiness or non-frothiness of a market, right? So if real estate's not looking very sexy, you can sideline your real estate investments and you can jump into business acquisition or something like that. And that is something that actually BlackRock did when they spun out Blackstone, and also Sam Zell did. So both of these big they just went to buying businesses. When the buying business market sucked, they just went to buying houses. So there are always opportunities to buy. It just might not be in the asset class of what you know about or are interested in. So this is, I think, really that's really sums up my strategy here going into this housing market. I'm going to chill. I'm going to wait. If there's a screaming deal that comes along, that's totally fine because I have a longer economic advantage. I have a longer time horizon of like 30 years. So if I buy it a little too high, and it goes down the next 2 to 5 years, that's fine. I'll have 25 years to make it back up. So some of the things that do level out some of the uncertainties of the market is a longer time horizon. So anyway, think about that. I love doing these videos. It really, really gets me so excited. Sometimes in crypto, I kind of struggle to think of things to talk about for like 8 minutes, but on these real estate videos, like it's already 11 minutes, and like I could pretty much go on for another 30 minutes. Like it was hard to cram all that shit in. Anyway, more videos to come. Y'all are great. Like and subscribe to this channel.